Welcome back. Before the rupee or the bond markets could react to the budget, these markets have got shaken by the tariffs imposed, or at least threatened to be imposed, by President Trump on Mexico, Canada and China. The dollar index up 1.25% from where we left off on Friday, and the rupee is at a new low. It's fallen 0.75%. I mean, I've not seen this kind of a sharp fall in a long time. It's about 75 pies cheaper than where we left it on Friday. 87.20, it even went to 23 per dollar. The government borrowing for FY26 is very marginally higher than this year's and versus what the market was expecting, but that's really a rounding error. Despite this prudent budget, will the Reserve Bank have the guts to cut rates in the face of so much external uncertainty? I have with me two guests, B Prasanna, the head of global markets at ICICI Bank, and Kaushik, the Economist from Deutsche India. Gentlemen, good morning and thank you very much for joining me. Prasanna, I'm cutting the budget for the moment and going straight to what is, a huge issue on the currency markets today. Do you think this uncertainty can impact RBI decision-making in a big way?
So I think, yes, Latha, markets being markets, budget is already history, and within a day we have got so much of information that markets are now reacting to other kinds of movements. Yes, I think the uncertainty is increased to some extent. I think all of us in the markets were expecting some kind of announcements from Trump on the day he was actually taking charge as president, or in the first 1 or 2 days through executive orders. But the kind of bonhomie that was there between him and Xi and the other presidents kind of, got some complacency into the international global markets again, basically with the view that Trump might not go all the way. But I think clearly what has come yesterday has surprised the markets, I would say a little bit on the shock also. And the fact that it's not just announcements, but they're actually going to start collecting tariffs from tomorrow. So I think the natural reaction for currencies would be to depreciate. The non-dollar currencies will depreciate against the US, and what's happening in INR is also more of the same. As far as your question on RBI is concerned, I would say that in a normal situation, maybe RBI would not be cutting rates when the currency is depreciating. But what is happening right now is a part of a global move where the dollar is strengthening and all the other currencies are depreciating. It's not because India's current account deficit is weak. It is only India's balance of payments are weak only because of the capital flows, which actually means if you actually cut rates and can get better earnings on the corporate side, you can get better growth and hence hopefully a better flows going forward. So I don't think it derails the rate cut, but at the same time, I would also have to admit that the uncertainty is killing. So, I mean, the odds, I mean, we'll have to see what the RBI does.
Okay. Well, there is one argument which is constantly put that after all, India has not got so much of bond inflows. It is not interest rate differential that foreigners are vying for. Foreigners come to Indian equities because India is a growth story. And there the rate cut will actually help. So will that cut, at the moment, what are the odds, therefore, for a cut?
So, Latha, the question is to me. What I would just say that the argument is sound, but I also would have to say that we are not out of the woods as far as the global dollar strength is concerned. I think we need to see it playing out, and I don't see international investors returning to India in a hurry, unfortunately. While I think the budget is very good and it is played within all the parameters of fiscal conservatism, while at the same time pushing consumption, not compromising on capital expenditure. But the thing is, it has to start reflecting into corporate earnings into India, which might take maybe a couple of quarters. And the dollar strength will have to play its course, and we'll have to see it peaking. And then only, I think, international investors will even start looking at, the rest of the investing asset classes.
Fair point. Kaushik, that straight away lobs the ball into your court. Do you think that given the kind of noises the budget has made, push the pedal on consumption, are you changing your growth forecast at all for next year?
So, Latha, we already have a growth forecast of 6.5% for next year, FY26, which is somewhere in between 6.3, 6.8, which the economic survey has kind of indicated. So we don't need to change that forecast, but the point is that 6.5% growth is probably below the potential growth rate of the economy. And this year also, we are supposed to get something in between 6 to 6.4%. So you need some support. Now, the point is the budget has done the maximum that it could do given the fiscal space. Beyond that, we should not have expected more. But then I've always maintained two things. One is you cannot depend solely on the fiscal to support growth, given that they have to keep on consolidating. Therefore, monetary policy has to play a bigger role, and RBI has been on hold for 24 months when the maximum in the past has been 11 months of a wait period. So we are already late, and RBI has started these liquidity easing measures, which will help, but they need to do more. And rate cuts, there's no point delaying it because today you have this uncertainty because of US tariffs. If you decide to, kind of wait and go in April, even in the first week of April, you could have the same uncertainty and, you could keep on delaying this. So the second important point is that you cannot, link interest rate and FX policy at this point of time. FX has to, have its own course. It should be a risk, absorber kind of a, objective. So if the rupee has to depreciate because globally dollar is strong, that should be the path. RBI can, modulate that move, but it cannot use the interest rate policy as a defense for the FX policy. The interest rate policy should, kind of focus more on the domestic. Demand, fundamentals. And over there, we think some bit of rate cuts are required in February and April, along with liquidity easing measures.
Okay, so there, I'm glad you brought up the liquidity point. Prasanna, should we expect a CRR cut? Because clearly what is given is not enough. That's,
Yeah, Latha, I think till end of the year, our estimate is around 1 lakh to 1.25 lakh crores of further liquidity infusion is required at the minimum. But the fact is, RBI did not really wait for the policy to implement some of the liquidity measures, and also they have been pretty aggressive in their in commencing their liquidity operations. You've seen them announcing auctions of 60,000, 20,000 has already happened, and not only that, they are now also more aggressively buying in the secondary market on the screen in government bonds. So the sum total of all of this will give you around 1.5 lakh crores. But like you rightly said, it's just not enough. And one call that the RBI would need to take, obviously, is that since they have moved from withdrawal of accommodation to neutral, and maybe they don't move the stance from neutral to accommodating stance, but at the same time, they can take a call that they want to keep liquidity flush with the banking system rather than making the banking system borrow from RBI using whatever tools like VRR. If that is the case, then they will need to give more than 1.5 lakh crores also. So that's a call they have to take. But since they have already announced a lot of measures, I'm still not willing to rule out a CRR cut, but the probability has come down, Latha, of them doing a CRR cut. They'll probably use a combination of OMOs and buy-sell swaps going forward to, infuse this liquidity. Because somewhere I feel that at 4%, they feel that 4 to 3 cushion which they want to keep. I think they want to keep it for a crisis situation. I won't call this exactly a crisis.
No.
Yeah.
No, I take your point. We are nowhere near taper tantrum or Lehman kind of. We are not at all in a crisis. Kaushik, therefore, what's the in-house view on the dollar rupee? Are we at the low, like 87.5 thereabouts? And what kind of a bond yield range are you looking at, Kaushik? I thought you're factoring in 2 cuts.
Yeah, so Latha, a couple of things. One is dollar rupee. I think this year you will see more two-way movement. It's not like obviously now rupee is under pressure, it'll depreciate, but there's a point of time when DXY will also peak. And you'll see other currencies appreciating when all this fear factor is over. I think at that time, RBI will allow INR to appreciate as well compared to the last few years when INR never used to start depreciating from. So taking all that into consideration, I think, rupee could be at 88 by the end of this year. So it could move to 88 first, and then you could see a appreciation at some point of time back to 86.5, and then again go back to 88. So I would say 88 would be the range for rupee going forward. As far as bond deals and interest rates are concerned, just to add a little bit more on liquidity, I feel that RBI will not be cutting CRR anymore. They have done it already in December. Beyond 4%, they would not like to move. As Prasanna said, this is not a crisis-like scenario. They can do more buy-sell swap, another 5 billion. They can do more OMO purchases. And, once they have started OMO purchases, already it will be about 90,000 crore this year and maybe more this fiscal year, and more would be coming in the next fiscal year. I would assume more VRR more OMO, more FX swap, but not CRR at this stage. And if you've seen carefully that the 56-day VRR is supposed to happen from 7th February.
That's right.
That is the day when RBI, if it delivers a rate cut, people would be willing to take that money. And you'll see that 56-day falls on the next policy on 4th April rollover period. So I would expect 2 rate cuts on February 7th and April 4th, coinciding with the 56-day VRR rollout. Bond yields probably would be somewhere around this same levels because market has already priced in 50 basis points rate cut. If there are more expectations of rate cut going forward, then you could see bond yields falling more than where we are. But more or less, we are at that level. But the negative side is also not that much because we have...
That. Yeah, got that. No, I got that. And that's good calculation to show exactly why you are expecting a rate cut. If you do a 56-day repo before February 7th, obviously you bankers will not buy it because you will be expecting the rate cut. I take your point over there. That kind of seals the rate cut. Very quickly, Prasanna, something which I think equity analysts are not speaking about much. I'm going to ask you an unfair question. Do you think banks' retail loans will go up now? This is a pro-consumption budget. A large number of people have 1 lakh rupees more or are going to pay less tax. Isn't this a pro-retail loan budget?
So I think, Latha, I think it's too early to comment on that. Yes, it is a fact that the 1 lakh crore of giveaway on tax will probably lead to something like 75,000 to 77,000 crores of incremental consumption, assuming a marginal propensity to consume in that region. But and that also happens on a recurring basis, adding to every year's GDP. But that's too early to say at this point of time. I think what the Reserve Bank does in terms of signaling, in terms of risk weights, in terms of what happens to EMIs, I think some of those things are also going to be important in terms of what happens at the credit growth level. And just to quickly, complete the circle on the rest of the things that you asked,
Rupee and bond.
was basic. Yeah, so it's basically on the bond yield side, we believe that there will be a bullish steepening with now the rate cuts getting starting to get priced in at the shorter end of the curve, while at the medium end, at the long end, maybe not as much. So because the absolute level of yields are also on the lower side, and it doesn't make it too attractive for banks to keep buying at lower and lower yields. So I would say 660 on the 10-year by 31st March and 650 to 660 kind of range for the calendar year at the end of the year. And on the INR, I would say I would agree with what Kaushik had to say, which is that this year we are going to see a little bit of two-way movement. Hopefully, RBI allows the rupee to appreciate also when the dollar has peaked. We haven't seen them allowing the rupee to appreciate because they were very keen to pick up reserves when rupee was appreciating. But this time around, since they're also allowing the depreciation, like you rightly said, 0.75% depreciation today compares favorably with some of the other EM currencies which have depreciated 0.5% today. So from that perspective, if you allow the rupee to depreciate, you should also, kind of allow the rupee to appreciate as well. So a little bit of more two-way movement, little bit of higher realized volatility in the FX market, which will then also encourage corporates to hedge. So those are all the good things. And frankly, monetary policy should not, the currency movement should not come in the way of what they want to do for monetary policy, because that will be focused on supporting growth, and India's CAD is still very strong.
Okay, point taken. Thank you very much, gentlemen. Unfortunately, out of time, but very important takeaways. We have to wrap up on Bazaar on that note. Chartbusters coming.